All right, for today, we're going to continue our discussion on standard costing. We did, I thought you guys, we all did, I think, very well on the exam. It's not one of the easier ones. In fact, it was a little more harder for some than the Chapter 6 exam, which, again, it depends on the questions and those multiple choice questions. There were some that were tricky. I certainly see that. And that's some of the difficulty, but overall, again, done very well. We have, again, our standard costing concept continue here in the second half. We actually will start on page 543 in Chapter 10. Because of that fact, we also will touch on Chapter 14 and basically do half of that. Our time frame for this discussion material is basically, let me get to the template here.
2 weeks.
2 weeks from today we'll be done. 2 weeks from today we'll be wrapped up by the 8th. I also want to make note here a couple things. On the adaptive study, there's actually 2 of them for this chapter or this section because we are in 10 and 14. So I also extended the due date to May 8th so that it comes up to the test. So if you wanted to practice up to the test, you certainly can do so with the that adaptive study plan. Remember, today is the day, the 24th, where the concept should be completed for the 5 points. Also, the problem 1074, I'm looking right here, the 25 points is a TSA problem. Again, cost has 4 of them. This is the 4th. So we have to maintain that 77% completion rate on that particular problem. It's similar to what we did for last test. You have to compute the variance amounts for that problem. So it does not take long. Again, I've handed out templates to everyone. Those are the ones we should use to complete the variance computations. It seems like the templates help, so that's good. I'll continue to do that, and hopefully they'll be a help this time as well. Also, for the exam, I would like it done in class like we did last time, so let's continue that process. All right. For the overhead computations. Oh, I did want to give this some. I have this in my notes. I don't know why I put it here, but I did. Just for something fun to do or read about. Setting a goal. If you have a goal to eat Big Macs, this person has eaten 30,000 of them. It took them almost, 40 years to do it. He eats 1 a day for lunch. I don't know if I could do that. So I just put some fun facts here. And did you know there's approximately 385 to 400 sesame seeds on a bun? That's always neat to know. There's also, Big Mac is second to what's the most popular? French fries. They beat out the Big Mac. And just different prices charged in Switzerland, Kazakhstan, and basically it was created by a person in Uniontown, Pennsylvania for the mill workers. 1 patty was not enough, so it was usually a single patty with a cheese inside, and so they put 2 patties and 1 burger and then added the pickles and onions to make the Big Mac. So started basically because it wasn't enough for a sandwich for some people. So anyway, and I know the 2 patty with the bun in the middle, that was so that it would hold together better. So and not slide around. So that was innovative at that time as well. So just some fun things to talk about a little bit, rather than always this cost stuff. Okay, so we talked about material and labor variances last chapter. Now we're going to talk about the overhead section. And it's very similar in format. And we're going to continue this applied overhead concept. And we're going to compare that to the actual overhead dollars. This difference is known as a variance, just like last chapter. And we again will have 4 variances to tackle with this particular section. We will continue our spending variance. What did we pay versus what we should have paid, right? We also will look at efficiencies, and the reason we have this here is that our driver will be direct labor hours. So we'll see how we were efficient-wise. Second, or next, our third variance will be another spending variance, but on the fixed overhead items. And then finally, our new one is called volume variance, which is a capacity measure. Now we'll talk about what's in each of these. We'll talk about what's in variable overhead, what's in fixed overhead, and what is meant by volume variance as we go through our discussions today. So, I'm just trying to see if my recording is working here. Oh, this is weird. I'm just hoping my recording's going. Okay, I was just checking to see if it did or not. It looks like it is. Okay. Sorry for that. On page 544, 543, I'm sorry, we're looking at total variable variance. Here we can see, again, the actual dollars compared to the applied overhead. And here again, the author will use these letters, SVOR. That is the standard variable overhead rate. SH is going to be the standard hours allowed. Just like we had when we talked about direct labor, that SH and this SH are the same thing. Standard hours allowed. Now, back in chapter 4, we had another name for this SVOR. It was called the predetermined overhead rate. So SVOR and predetermined rate are the same thing. So we will again have to compute the predetermined rate. To do so, we took the budgeted overhead, in this case the variable amounts, in dollars, divided by a budgeted level of direct labor hours. So we will continue that. We learned this in chapter 4 when we did job order costing, and we'll do it again in this chapter with our applied overhead amounts. So, hopefully some of this will be a little bit of a review, maybe. So we'll do our best as we go through the chapter. We are going to use the columnar approach, which I give the templates out. And exercise or example 7's on page 544. We again will be distinguishing between favorable and unfavorable variances. This designation, favorable and unfavorable, did catch a few of you on the last test. So just try to be careful. Make sure you're going in the right direction. And again, like we did with materials and labor, we're going to break it down into our spending and efficiency amounts and find out who is responsible for those amounts. In most cases, it's going to be production. So let's just try to do one of these problems. And we'll come back to who's responsible. Let's try 56, guys. So grab a template. I can always talk a little bit easier with numbers. And I'm hoping it makes more sense with numbers anyway. It's on page 573 of our book. You'll notice that the template is broken into a variable section on the top half, a fixed section on the bottom. So we can do both with one template, and that's what we're going to do here. We're going to do both if we can. 56 is the variable part, 57 is the fixed part. Guys at home, are you set with your templates? Okay, thanks, Austin. Jade, awesome. Great, thank you guys. Sam, are you okay? Oh yeah, you said yes. Okay, I see you. Jade, are you okay? Oh yeah, she said yes too. Okay. Oh my gosh. Is it the weekend yet? I'm hoping soon.
Almost.
Almost. Oh my gosh, it's only Wednesday. All right.
It's halfway there.
Halfway there. Good thing. We're looking at overhead. And in 56, it says, first compute the standard hours allowed for the actual deliveries made. Question 1, they want to know the SH. Number 1 question, what is the standard hours allowed for this particular company, which is a delivery service? And a lot of things are happening around deliveries today, right? Food can be delivered, groceries can be delivered.
Pretty much anything now.
I always say Uber, it's Uber, right? Uber Eats, is that what the delivery is? I have some friends actually making deliveries. So what we have to find out in order to figure out the allowed hours is look at our actual production. Now, it's not making something, we're actually doing deliveries here. So what were our actual deliveries here?
38,600.
Yeah, the 38,600. And how long should it take to make one delivery?
80 cents.
0.8 hours, right?
Yep, 20 hours.
So I'm going to multiply this by the 0.8 hours. And we should get our first answer, allowed hours. Which which is how much?
30,800.
30,800?
Oh, 880.
30,880. Now, what's nice with this section is that allowed hours can also be used for the fixed overhead. They're one and the same. So they're the same color box here, so put the 30,880 here as well. All right, we're somewhat familiar with the templates. From the problem, what other numbers can I put in?
The $157,700 for actual and variable overhead.
Yeah. So there is no computation, it's just one number. Now, what I would like to know is what are we talking about here? I know the book says variable overhead, but okay. What accounts are we looking at here? We're looking at a delivery service. What do you think we would have here? What's the big one usually that's variable?
Gas.
Gas, utilities, I was thinking. Yeah, very good. Excellent. Michelle, you said something?
I was just thinking like the gas and the maintenance of the vehicle. Maintenance.
Maintenance, yeah, excellent, yes. The more hours or miles I put on, I'm gonna have more maintenance, right? Either parts or somebody fixing it. Yep. I was thinking miscellaneous supplies, right? Not direct labor or materials, but miscellaneous supplies. Probably put gas under direct materials because they're driving.
Oh, yeah.
That would be pretty easy to track. It's something visible. We could have janitor wages, right? Maintenance wages. We could possibly have all our variable payroll taxes here. Workers' comp.
What, like depreciation?
That would be down in the fix. Depreciation's down in the fix. Let's see. What else would a delivery person be doing? I think there's more probably, but that's a good list. All right, good. What else do we know?
Or actual hours?
Yeah. How many?
31,000.
31,000. Excellent. So what's my efficiency variance going to be? Austin, are you with us? What's my efficiency variance going to be? If my actual hours were 31, my allowed hours are 30,880. Am I going to be efficient, favorable, or unfavorable? Does Austin said favorable.
It's unfavorable.
I think it's actually unfavorable, Austin. If I look at my hours here, my actual hours were greater than my plan, so that is unfavorable. Does that make sense, Austin? Cool. All right. What else do we know? We got to get the green box. What's the green box amount?
The standard variable overhead rate.
Yep.
Yeah.
One thing,
Yeah, good job. power, 5.10, $5.10. $5.10. Great job. So this was given to us in this particular problem. Other problems it won't be. You'll have to compute it. So if we multiply those out, I have 158.1. I have 157,488. A difference of 612 and 400. What's the spending variance? Favorable or unfavorable?
Favorable.
That one's favorable, yep. So we have a favorable spending, an unfavorable efficiency. We can net the two together, and it would be which direction?
Unfavorable.
Unfavorable, right? Okay. All right. So now we said we have a problem. You're the manager of this delivery service, right? We planned on having 30,880 hours for our 38,600 deliveries. We come up with 31 for the period. Who do you talk to about that?
Your driver?
Your drivers, right? So we have a problem here. What do we know about drivers?
Some go fast, some go slow.
Yeah, so we may have an issue with training,
Direction.
directions.
And some things out of your control, like traffic.
Traffic,
Weather.
Right, maybe there was trains, weather.
weather's an issue.
Oh,
Okay, you're really giving this person the benefit of the doubt. I'm more cynical. What else could be the problem?
Maybe they just took their good old time from the.
Yeah, maybe they took a personal trip. Maybe they fell asleep on the job, right? Something like that, right? Could be the cause also. But again, you have to have a standard. What else could be the problem?
or could it break down?
Broke down? Yep. But also, is .8 a legitimate standard time, right? We always have to look at our standard rates to see if they're appropriate. Things change. Cities get bigger. .8 may not be adequate anymore. Maybe we're making our deliveries too far out, right? We're going way past our range to get the sale. Well, it might not be worth it. You might be spending more in gas than what you make on that particular delivery.
Yeah, that's
So-
what a lot of businesses are doing now. They only deliver to a certain area.
Well, yes, you
Yeah.
have to. You can't afford to go out beyond that. So that's what we're talking about here. This type of analysis is critical. Now, we have a favorable spending variance, which is good, right? In a lot of cases, the spending is out of our control because who sets the prices? We don't, right?
Yeah.
WPS doesn't say, well, what do you want to pay? So, but there are things that we can do, maintenance-wise, supplies-wise, where we can control some of that, how much we use. How often do we do our maintenance? Do I push it off and then I have a bigger bill later on? So that again is giving us some information of how well we are doing. So always important to look at. All right, so let's go down to the fixed overhead, which is problem 57. What numbers do they give us there?
The actual fixed overhead.
Yeah. 403, 400. Now we already mentioned that depreciation is here. Depreciation on what?
Vehicle.
Vehicles? Probably what else?
Machine,
Pardon?
equipment.
Yeah, maybe computer equipment. I'm sure they got some kind of reservation system. What else? Rent or lease, right? Maybe we lease our vehicles. Maybe we rent our building. Maybe we don't have a contract. What else? Supervisor salary. Owner's salary. I know they don't get a salary, but it's a draw, right, possibly? We have to pay them. Now I'm getting into the admin a little bit, but that's, we're delivery service, so I think I'm okay with this. What else did you say, Teresa?
Insurance.
Yeah, insurance is down here. Auto insurance, right?
No, that permit, isn't there any like special?
There's general liability insurance, yep, business insurance. They call it general liability. Probably the biggest one is auto here. Yeah, exactly. So the difficulty with setting these budgets is the number of items. It's much easier to do material and labor because those are the ones we pick a couple that we can focus on. Here you could have hundreds of items that make fixed overhead. You could have hundreds of items that make variable overhead. When I do my budgets for my clients, this is the area I spend most of my time on. How do you get a budget number for every one of these? And what's going to change next year? That's the hard part. So, we come up with our actual numbers. What was the budget for the year?
400.
The 400. Yeah. And obviously that's a 3,400 difference. Jade, favorable or unfavorable spending? 4034 versus 400. Unfavorable. Awesome. Very good. Okay, good. Now, what is our SFR, standard fixed overhead rate? I'm going to do a computation. I hope you have room here. These predetermined rate, standard fixed overhead rate, is budgeted dollars, and we've got to use fixed over some budgeted level of direct labor hours. So dollars on top, make sure that is always on top. and our driver is the denominator. So the book already gave us the top number. That's the 400,000. What's the bottom number? They don't call it budgeted labor hours, they call it what?
Is this the 32,000?
Yeah, the practical capacity. Remember, volume is a capacity measurement. So the practical capacity was 32,000 direct labor hours. 32,000. So if I take 400 divided by 32, Ruby, you have it?
12.5.
12 and a half?
Yes.
This is our SFOR, 12.5. So for every hour I drive, right, I'm contributing $12.50 to pay for my overhead. Is basically what it's telling me. So, Michelle, do you have this quantity?
386,000.
Oh, that's nice. So 14, and which direction?
It's unfavorable.
Unfavorable. Very good. So here's another 14,000 unfavorable. I added to the 3,400. I now have 17,400 unfavorable. And that completes the template. Now, we must make certain that we understand this term capacity or volume. So I'm going to make a new note here. What does capacity mean? If I'm making something, what does capacity mean?
The amount you can hold up to.
Pardon?
It's like a limit that you can hold up to or whatever you can hold.
Capacity is what I can hold, or the
Ability?
what?
Ability?
The ability to make these many units. Now I know it's deliveries. What is the maximum, what I expect to make next year? How many units? My capacity measurement. Now, normally, the capacity is determined by machine time, right? I can only push so much through my machines, or I can only make so many units in a particular day. So they estimated the capacity level was 32,000 hours. That was my prediction for the year. Now, this capacity or volume, if I took the 32,000 direct labor hours, I divided it by 0.8 hours. How many deliveries is that?
40,000.
40,000. I'm sorry, I'm so low. Ruby probably, what the heck, I can't see a thing. Okay? That was what we planned. This is what we planned. What did I actually deliver? How many deliveries did I actually make?
38,600.
I forgot the R here, did I not? That's still not right. Let's start over. for 40, I did 38,600. I'm short what?
1,400.
Is that a big deal? It's a big deal.
Yeah.
Okay? I'm going to cross out unit, I'm going to put in delivery. So we have direct materials, direct labor, we have variable overhead, we have fixed overhead. What happens to these two? Well, we budgeted 400,000, right? For 32,000 hours. It was 1250. Correct?
Correct.
Well, what if I divide it by, what were my actual hours?
31,000.
Even? What's my cost per unit now? Here's what I planned, right?
Like 1,290.
$12.90. It's 40 cents. $0.40 difference. Now, it's not a big deal, but when you're talking as per hour, that's $4,000, right? Basically. So it adds up, basically. There is a lot of pressure on production managers to do what? Produce as many units as they can. The goal was 40, they're short, that cost per unit goes up, and that's what I want to show you. And it has a tremendous effect on your operation. Because remember, we based the selling price based on those standard costs. That's where we got our selling price. And if we don't hit those cost figures, we're going to lose money. And that's what we don't want to happen. What if we made more than the 40,000 deliveries? What does that do to our cost per unit?
Goes down.
Goes down. So, very, very, very important. And because a lot of our cost now is wrapped up in overhead, it's even a bigger problem if we don't hit our production levels. So that's why there's a lot of pressure to produce when you're in the factory floor. You gotta keep making, and that's why. Because, again, the supervisor is evaluated on, did they meet the production goals or did they not meet them? So we have a problem here. What are we gonna do about this problem? We didn't meet the goal this year, so do we just set the bar lower next year? No.
It's small.
You gotta find out what's wrong. What would you do to improve your number of deliveries?
Training, maybe.
Well, we gotta have, one thing we gotta have is sales, right? So we gotta promote more maybe to get our sales numbers up so we can make more deliveries. Certainly look at our geographic range. We can't be delivering in Pulaski. I could do 2 runs here in town versus 1 run out to Pulaski.
Yeah.
You know what I mean? So that's where that range comes into play. So that's another thing to consider. What else can we do about our budget?
Cut the budget or the overhead, some of those.
Get this number down, right? Do we need to rent a building? Can we lease a different one? Can we run it out of our house? Right? So there are a lot of things that we can do, not only delivery-wise, but also cost-wise, that will make our numbers look better. So here again, if I don't have a roadmap, I can't change things very easily. So you set a budget, a standard, and then from that standard, we learn a lot about our operation. And that's the goal here.
Can I ask where you got the 31,000? Down. Yeah.
Somebody gave me the actual hours.
It's
Yeah, oh yeah, it's right there.
Box up ahead.
Direct labor hours was 31,000.
It goes with the same.
Oh, up here, gotcha.
Yep.
Thank you.
So this is the actual, this is what we thought. This was the plan. This is the actual. So not only were we not utilizing our capacity level, we also were over on our cost number. In reality, this was 403, so it's actually more than the 1290. So we lost in both cases. So we do have to do something about our costs as well. I'm sorry for the extra words here. It didn't get cut off. Is it on your template? Yeah. It didn't get cut off. This test doesn't have a lot of journal entries. I'm just going to point a couple things out here. Let's start with the variable one first. Oh, here. I know at home they don't have it. I've given out a journal page, but you really don't need it. It's just a little neater. All we need is one for this stuff. So we're going to use this template to make our journal entry amounts. The recording of the variances are all done at once. So I'm going to have a debit, skip 2 lines, and then a credit. On your template, do you see the word applied? Let's start with the variable. Do you see the word applied? Way on the right, correct? The top right number. So this is the number we're going to use, the 157,488. What account is it applied to? Which one?
B.
Yeah, very good. Excellent.
Do we still use WIP even in delivery?
Yes.
Okay, let's.
Normally we wouldn't, Tom, but to be consistent, I
Okay.
think we are. Uh, 157,488.
Yes.
We'll next record the variances. Which one's the debit one? There's one debit, one credit. Which one's the debit?
Efficiency?
The efficiency is the debit one, right? It's the unfavorable. So variable overhead, efficiency variance. And Diane, that was what?
612.
612. So the credit then is going to the variable overhead spending variance. And that was 400, correct? And then my last account is going to be that manufacturing overhead control. control account. That was the 157.7. Remember that term over or under applied? That 212 is under applied, back from chapter 4. But now in chapter 10, that 212 is in its different variances. It's part efficiency, part spending. Back in chapter 4, we just called it 212 under applied. We compared what we put into WIP and what we should have put into WIP, right? Okay. Also with the variable, we record the actual. So I'm going to debit manufacturing overhead control. We don't use expense in cost world, right? So we're going to debit this. And now I'm going to credit, and we won't have these guys. There's no numbers to these. Supplies, utilities, payable, right? Maybe we had some wages payable. Whatever's in the variable section of our operation, we'll credit all of those accounts against the manufacturing control. This is exactly what we did in chapter 4 with these journal entries. So remember, when recording, the unfavorable are debited, the favorable are credited, right? When we close, and again, some of the entries were backwards. When we close it, we got to reverse that order. We would debit the favorable ones, credit the unfavorable ones when we close it. So that's our journal entries. Fixed overhead, pretty much the same. You see the word applied on the fixed overhead template. Yes. So I'm going to debit work in process inventory for the applied amount. 386. They were both unfavorable, both the spending and the volume. So I'm going to be debiting both of those. Fixed overhead spending variance. Fixed overhead volume variance. Forgot what was the amount? 3,400 and 14,000? Yeah. Push it up here, guys. And I'm going to credit, again, the manufacturing overhead control for the actual amount, 403,400. And this too, obviously, there's an actual entry for fixed overhead, which is going to be, again, a debit to the manufacturing control. And then all the credits. The big one here is accumulated depreciation. on equipment, on autos, on whatever's in our operation. Maybe we have a supervisor salary, owner salary, draw. Maybe we have here insurance, we talked about some insurance in here, rent in here, leases in here, all payables, right? We're crediting those to put them into our control account. So here again, we not only record the variances as they occur, but also helps us to identify where our problems are, right? And that's the goal here. That's the control feature here. Now in the appendix, they don't show any of these two journal entries. So you will not be tested on journal entries. But my main focus by doing this is I want you to understand why I have the word applied up there. Because again, that applied amount is what's going into work in process inventory. And that's how we analyze the planned amount versus the actual amount to see where we're wrong, where we're having trouble, and how to fix that problem. That's the main thing. I know you guys can use the templates. It's not that you can't use the templates and putting the numbers in the boxes. But what I want you to understand is why we're doing it and what can we learn from these variance numbers. What's the story? These numbers talk to us. So we got to figure out what we can do to fix our problems. That's the main goal here. Okay, guys, let's take our first break here. On page 545, 546, like we did with materials and labor, they talk about who is responsible. And take a few minutes on your own, obviously, to read these couple pages. One thing that I like to point out, remember, variable overhead is not a single input. There's a lot of things that make up variable overhead, and that's what makes it so difficult. To budget for, because of those numerous items, and so many factors can change that amount depending on what the item is. We are going to use as our driver for overhead direct labor hours. I don't know if you remember back when we did chapter 4, we had direct labor cost, we had machine hours. Here in chapter 10, it's only going to be labor hours. So that makes it a little easier again to use our templates. In addition to that discussion, it talks about what creates a spending and efficiency variance. So they start out with price variations, right, can cause our spending variance. But also remember with our overhead that it can be also waste or inefficiency. Think of our supplies. Here again, I could use double or triple the supplies that I plan to use. So that inefficient use could be causing my spending variance as well. Maybe I'm putting 425 sesame seeds on a bun instead of 400. That again would be considered an inefficient use of that. You ever go to Subway? There's only so many pickles they're supposed to put on, right? There's only so many of this to put on. So same concept. So that's what it's talking about here. That spending variance can be more than just price. So in that case, if it's price and efficiency both, well, that's gonna tend to be who's responsible would be our production person. So, remember, before we can talk to somebody about a variance, we have to be sure they have control over that part of the operation. So you can't be yelling at somebody for a variance when they don't have the control. So that's where that research really comes into play here. Also on page 546, actually 547. When you do your assignments, I know we use the templates for our variance computations, but the book also has another view of these templates. So if I could have you go to 547 in our book. I'm just going to jump there myself. I just want you to be aware of how this template compares to our template. This is a performance report. They call it a performance report. Again, this is on page 547. You notice that there's a cost formula here. We're only looking at two variable overhead items, maintenance and power. Obviously, there would be a whole list of these. It has the actual dollar amounts in the next column. And then what's confusing is that I have two budget sections. One for price or spending, one for efficiency. So your job will be actually to predict, right, what is my budget number so that I can then compute my variance amounts. So this is a different layout than our templates. So I want you to be prepared for this. So how do we get these budget? Now it says actual hours versus standard hours. Here's my SH, here's my AH from our templates. Let's start with AH. There were 10,500 actual hours. So all I'm doing is I'm taking the 10,000 times 275. That gives me the 28,875. $1.25 times 10,005 gives me the 13,125. So in reality, we're doing the same thing as we would in our templates, but it's by item. Maintenance, power, supplies, by item. Now, the allowed hours were 10,000, so that's how I get these numbers. I'm taking the 10,000 times the rates, the cost formula rates, using the SH hours, standard hours allowed for the actual production. Obviously the variances then, I'm looking at my actual compared to my budget. $2,000 difference, my actual was less favorable. Here I had, again, less than 13,125 favorable. To get my efficiency variance, now I'm comparing, oh shoot, the board moved on me. I'm not comparing the actual anymore. How can I do this? Let me do this in purple. To get the variance efficiency, I'm looking now at these two numbers. I'm not starting with the actual anymore. So comparing these two numbers, I get 1375 unfavorable. And I'm comparing these two numbers to get the 625 unfavorable. Just like we would in our template. Just like we would in our template. But again, on an individual line basis. So hopefully it makes sense. Any thought or question?
Is that kind of how they want us to lay out and say engage when we do the homework?
On some of your problems, they'll look like this.
Okay.
Yeah.
Just so we will be prepared.
So, yep, just be ready for it. The problem is getting this variance amount, right? Don't go back to the original cost. You're starting from the budget spending amount and then comparing it to the allowed amount. So here to here gives you here, then here to here gives you this. That's what you gotta be ready for. And in reality, guys, we're doing the same thing on our templates, right? If I go to the one we just did, here, to get the spending variance, right? I'm comparing the actual cost to that middle number. To get the efficiency variance, I'm comparing the middle number and the end number. I'm doing the same thing on my templates as I would on my performance report. They call this a performance report. Now, I don't have any examples to show you. This might be even in a written format as well. So, see how you do with it. Let me know if you have any questions with it. The other discussion is on fixed overhead, both spending and efficiency, and obviously who's responsible for that. I'm just trying to get to the slide. It talks about capacity here. Basically, for both the spending and the capacity or volume variance, it is the responsibility of the production supervisor. So on pages 550, 551, and I wanted to point this out. This is fixed overhead. How could weather create a variance? So it's here, the variance might reveal that beyond the control of management, like the weather.
Power outage?
Yep.
Heater AC because it's warmer or colder than what they expect it to be.
Yep, that would be utilities, that would be more of a variable. I'm keying in on power outage. Why is that? How would that mess up my fixed overhead? When the power goes out, what happens?
No production.
No production. So what? variance has to do with production levels?
The efficiency.
Not the efficiency, the volume. Yep. Yep. Look at the tsunami that hit Japan. It hit Japan's Toyota manufacturer suppliers. They were shutting down and they were in a panic, right?
Yeah.
Lots of production was lost because not only in Japan, but also here, because we couldn't get parts. So it was a huge, huge problem. And again, volume is the key when we're dealing with that kind of issue here. But what happens if I don't produce? My cost per unit keeps creeping up because I'm not making the number of units I plan to make, right? So that's the big deal here. So if you ever are a production manager, just say blame the weather. I lost power. Okay, all right. Something to think about. I think this is a cute picture. It just shows graphically a volume variance. I don't know how that's even relevant, but it's a picture, something different to look at. All right, let's try 58 for one more practice round here. 58. Page 573. Go ahead, take one of your templates. I'm going to stop the recording. And just, I'm curious, what's our SVOR, our standard variable rate? Okay. Guys, can we help Catherine out here? What did we use for the standard?
0.7.
Yes, 0.7. Very good. Excellent. I was actually looking, Kershaw, at the fixed rate. So good thing you said that. 0.7. So the fixed rate obviously then is what? Yeah, the 520. So the fixed overhead rate is the 520. How come I didn't use $10.40 and $1.40? What is that? That's per unit numbers, right? So we don't use those at all in this analysis. All right. How about SH? What's SH going to be like?
Actual production times 2.
Times 2 hours. Very good. And what is that, Polly?
159,400.
Start doing our math. Excellent. Here's 11. $827,840. 210, right? Efficiency variance. $1170, spending, right? E, which direction though? On the spending. Unfavorable? Any efficiency?
Favorable.
Awesome. Yeah, the 2, 910, 960. So how did this production manager do? Looking at our variances, how did this person do?
Not too bad.
Not too bad, pretty close, right? Efficient wise, very close. Actually, a little bit on the plus side. And then spending, maybe we had some rework or waste, maybe. Or maybe some prices changed on the vendor side. So again, maybe some research would have to be done there. On the middle number, that's the one that I thought was gonna be the hardest. Did anybody get it? Kershaw, how much did you get?
832,000.
How much?
832,000.
Excellent. How'd you get that, Kershaw?
80,000 times 5.2 times 2.
And what was the 80,000? What did we call that?
The
What did the author?
budgeted overhead
The budgeted
units. Budgeted units.
level of units. That's what we planned to make this year, was 80,000 units. Yep, exactly. Did I make 80,000 units? Not quite. How many did I actually make? 79.6. So we're about 400 units short. If I'm 400 units short, what's my volume variance going to be? Favorable or unfavorable? Right? It's not bad. 400 units out of 80,000 is not bad, but still slightly lower than what we would like. Do you have the differences? No. Who's got the difference here? The variance. I shouldn't say difference. Variance.
1,000 for the first one. Or not that one, yeah, that one's 1,000. And then there was 4,160.
Spending is
Favorable.
favorable. 3160 unfavorable. Awesome. Okay, again, didn't quite make our capacity measurement, but we did make up on our prices a little bit. Our costs were in line with what we planned. I'm going to expand a bit on this concept here for what Kershaw did to get this number. When we're looking at our standard fixed overhead rate, we've said it's the budgeted fixed overhead dollars, right, over some budgeted level of activity. And in this chapter, we're always going to be using direct labor hours as that budgeted level of activity. So what did the problem give us? They gave us the 520, right? They gave us the direct labor hours, which Kershaw did beautifully. He took the 80,000 units budgeted times 2 for 160,000 hours. This is even getting lower than I can go. That's hard to do, by the way. My stomach is growling terribly. Must be lunch. So that's 160,000 hours. You can probably hear it on the mic. Check it out. And what is this, Gary? What's this chicken scratch here? Let's start over. Oh my gosh. 2 hours. I gotta convert my units to hours. Right? Because this rate is per direct labor hour. So now I got apples to apples. 160,000 direct labor hours. So I'm gonna use algebra, right? Find x. How do I get x by itself? I multiply both sides of the equation by 160,000 hours, and that x is now going to be equal to 832,000. So the problems will give you different numbers. Sometimes we'll give you the 832. Sometimes we'll give you this and you have to figure out the 832, right? Sometimes we'll give you the 832 and this, and you have to find the rate. This is my SFOR rate, my predetermined rate. So every problem will be different that way. Okay. All right, I think I'm gonna stop here. That way you can get lunch or whatever. I'm hungry too, so I'm gonna get lunch as well. Have a great weekend. It looks like Thursday and Friday look okay. Saturday doesn't look too, I heard snow on Saturday up north. Have a good weekend. Be safe, guys.